Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's tourism industry showed further signs of stabilizing in July 2026, although international visitor arrivals remain slightly below the level recorded a year earlier. According to the latest tourism data, the country welcomed 196,845 visitors in July 2026, a 1.7% decline compared with July 2025. However, this marked a significant improvement from the sharp declines recorded during the second quarter when the industry was affected by aviation disruptions linked to the conflict in the Middle East. Although flight operations have improved, weaker arrivals from several traditional European markets continue to weigh on the sector. On a positive note, India remains Sri Lanka's largest and fastest growing source market. Visitor arrivals from India increased 20% year-on-year to 44,547, helping offset weaker demand from Europe. Meanwhile, arrivals from the United Kingdom, the Netherlands, France and China all declined compared with July 2025. Looking at the broader picture, Sri Lanka welcomed 1.34 million tourists during the first 7 months of 2026, a 1.8% decline from the corresponding period last year. India continued to lead cumulative arrivals with more than 338,000 visitors, while the United Kingdom and China remain the second and third largest source markets respectively. Looking ahead, the tourism industry still faces a significant challenge in achieving its revised target of 2.5 million tourist arrivals for 2026. With 1.34 million visitors recorded by the end of July, Sri Lanka will need to attract nearly 1.16 million more tourists over the remaining 5 months of the year, averaging around 231,000 arrivals per month. According to industry analysts, achieving that target will depend on stronger long-haul air connectivity, particularly from Europe, continued regional demand, and intensified global destination marketing ahead of the peak winter travel season. Tea remains one of the Sri Lanka's largest export industries, making price movements closely watched by producers, exporters, and investors. The latest auction data points to improving local prices, but exchange rate movements continue to weigh on returns in US dollar terms. Here's what the latest figures reveal. Sri Lanka's national tea sale average strengthened in July, supported by firmer prices for low-grown teas. According to the latest data, the national tea sale average increased to 1,176 rupees and 10 cents or $3.50 per kilogram in July. That was an increase of 22 rupees and 61 cents or 5 US cents compared with the June 2026 average of 1,153 rupees and 49 cents or $3.45 per kilogram. Compared with July 2025, the national average was 48 rupees and 50 cents higher in local currency. However, it was 24 US cents lower in dollar terms, reflecting the impact of currency movements on export earnings. Looking at the year-to-date performance, the national tea sale average reached 1,164 rupees and 50 cents or $3.63 per kilogram. This was 11 rupees and 43 cents higher than the corresponding period of 2025 in rupee terms, although it remained 24 US cents lower in US dollar terms. The report showed that low-grown teas continued to lead the market. The average price for low-grown teas increased by 33 rupees and 65 cents compared with June 2026 and by 85 rupees and 98 cents compared with July 2025, reaching 1,293 rupees and 6 cents per kilogram. Meanwhile, high-grown teas also recorded stronger prices. The average increased by 12 rupees and 70 cents from June 2026 and by 26 rupees and 58 cents from July 2025 to 1,061 rupees and 95 cents per kilogram. However, medium-grown teas remained under pressure. Their average price declined by 2 rupees and 62 cents from June 2026 and by 27 rupees and 96 cents compared with July 2025 to 953 rupees and 94 cents per kilogram. According to the Sri Lanka Tea Board, cumulative averages for high-grown and low-grown teas continue to record positive gains in rupee terms. However, all T elevations posted negative variances in US dollar terms compared with the corresponding period of 2025. The report also noted that medium-grown teas remain the weakest performing category, recording declines in both rupee and US dollar terms. Money circulating in the economy is an important indicator of liquidity and overall economic activity. The latest central bank data shows cash demand increased during the first half of the year, while reserve money also expanded. The figures provide further insight into the central bank's ongoing management of monetary conditions. Currency in circulation and reserve money increased during the first half of 2026, reflecting stronger cash demand and prevailing monetary conditions. According to the Central Bank of Sri Lanka, market operations report currency in circulation increased by 72.7 billion rupees to 1.64 trillion rupees by the end of June 2026. The CBSL said the increase was largely driven by festive-related demand for cash, while currency in circulation moderated after the festive period as money returned to the banking system. The report also noted that changes in cash holdings reflected the public's preference to hold currency in response to movements in interest rates. Meanwhile, reserve money, which includes currency in circulation and commercial banks' deposits with the CBSL, increased to 1.89 trillion rupees by the end of June 2026 from 1.80 trillion rupees at the end of 2025. The report also showed that CBSL's holdings of government securities declined marginally to 2.5 trillion rupees, mainly due to Treasury bond maturities. According to the CBSL, it has not purchased any new government securities since January 2024, meaning no permanent liquidity was injected through the creation of domestic assets during the period. The report added that movements in currency and reserve money took place alongside the CBSL broader liquidity management measures, including foreign exchange interventions and open market operations to maintain orderly monetary conditions. Sri Lanka's external sector is showing early signs of stabilization, but the broader pressures have not disappeared. While the trade and current account deficits narrowed for a second consecutive month, they remain significantly wider than a year ago. The latest data highlights both the progress made and the challenges that remain for the economy. Sri Lanka's external sector showed signs of gradual improvement in June 2026, with both the current account and merchandise trade deficits narrowing for the second consecutive month. According to the latest Central Bank of Sri Lanka external sector performance report, the improvement reflects a moderation in external pressures rather than a reversal of the underlying trend. The merchandise trade deficit narrowed from a record $1.38 billion in April 2026 to around $1 billion in May 2026 before easing further to $828.5 million in June 2026. The current account followed a similar pattern. Its deficit narrowed from $525.2 million in April 2026 to $194.5 million in May 2026 and further to $148.7 million in June 2026. According to the report, the moderation was mainly driven by lower fuel import costs. Fuel import expenditure declined from $886 million in April 2026 to $536 million in May 2026 and further to $465 million in June 2026. However, fuel expenditure remained 40.2% higher than in June 2025, reflecting the impact of higher global oil prices following the escalation of the Middle East conflict. Despite the monthly improvement, the year-on-year comparison remained considerably weaker. The current account shifted from $148.7 million surplus in June 2025 to $148.7 million deficit in June 2026. Meanwhile, the merchandise trade deficit widened 53.3% year-on-year as imports increased 17.3% while exports grew by just 0.2%. Looking at the first half of 2026, the current account moved from $1.44 billion surplus in the corresponding period of 2025 to a $245.4 million deficit. At the same time, the cumulative merchandise trade deficit expanded 67.9% to $5.49 billion compared with $3.27 billion a year earlier. The report noted that this is already approaching the $6 billion trade deficit recorded during the whole of 2024. Meanwhile, the services account also weakened. Its surplus declined 33.8% year-on-year in June 2026, while the cumulative surplus for the first half of the year fell 22.4%. The report attributed this partly to a sharp increase in outbound travel spending by Sri Lankans, which rose 70.4% in June 2026 and 82.7% during the first 6 months of the year. Tourism earnings also remained under pressure. Tourist arrivals declined 9.9% year-on-year to 124,551 in June 2026, while tourism receipts fell 10.8% to $151.1 million, extending the cumulative decline in tourism earnings during the first half of the year. The report also stated that Sri Lanka's terms of trade deteriorated further as import prices continue to rise faster than export prices. On a positive note, workers' remittances increased 23.2% year-on-year during the first half of 2026 to $4.6 billion, providing important support to the external sector. In addition, the primary income account deficit narrowed 11.4% to $894.5 million during the same period. Meanwhile, gross official reserves, include the People's Bank of China swap facility, stood at $6.5 billion at the end of June 2026, providing import cover of 3.2 months. The report also noted that the Sri Lankan rupee had depreciated 7.8% against the US dollar on a year-to-date basis by the end of July 2026, closing at 336 rupees and 5 cents to the US dollar. However, the CBSL said the pace of depreciation has moderated following recently implemented monetary, fiscal and macro-prudential measures. Looking ahead, the report noted that expenditure on vehicle imports declined 27.1% compared with May 2026, falling to $182 million in June 2026. According to the report, this could indicate the early stages of import moderation, although several more months of data will be needed to determine whether the improvement is sustainable. The central bank's foreign exchange operations play a key role in maintaining currency stability and strengthening Sri Lanka's external position. The latest figure shows continued efforts to rebuild foreign reserves while managing liquidity in the banking system. The report also provides fresh insight into the performance of the rupee and official reserves during the first half of the year. The Central Bank of Sri Lanka remained a net purchaser of foreign exchange during the first half of 2026 as it continued efforts to rebuild official reserves and support stability in the foreign exchange market. According to the CBSL market operations report, the central bank purchased $982.2 million and sold $425.9 million, resulting in net foreign exchange purchases of $556.3 million. The report said that these interventions were aimed at rebuilding reserves under the International Monetary Fund supported Extended Fund Facility Program, while reducing excessive exchange rate volatility and supporting essential energy imports. Meanwhile, foreign exchange purchases and swap operations injected around 262.5 billion rupees into the domestic money market, helping maintain adequate liquidity in the banking system. Despite some offsetting liquidity withdrawals, the domestic money market remained in surplus during the first half of the year, with average surplus liquidity standing at 199.5 billion rupees. The CBSL also expanded its foreign exchange swap operations, increasing outstanding swaps to $2.2 billion by the end of June 2026 as part of efforts to preserve gross official reserves. Supported by these foreign exchange purchases, gross official reserves reached a post-crisis high of $7.3 billion at the end of February 2026, before easing to $6.5 billion by the end of June 2026, while following foreign exchange sales and external debt payments. Meanwhile, the Sri Lankan rupee depreciated 7.9% against the US dollar during the first half of 2026. According to the CBSL, the depreciation reflected high import-related demand for foreign exchange, geopolitical tensions in the Middle East, capital and dividend outflows, and weaker conversion of export proceeds. However, the report noted that exchange rate conditions showed signs of stabilizing towards the end of June 2026. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 9.77%, down by 9 basis points. The 182-day T-bill rate stands at 9.99%, down by 22 basis points. And the 1-year T-bill rate stands at 10.19%, down by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.